Let's be real for a second. Few things are as universally intimidating or, as easy to put off as life insurance. You know it's crucial, but the second you start looking into it, boom, you're suddenly drowning in complex terms, conditions, and high-pressure sales pitches. Well, not today. Welcome to this explainer. We are literally stripping away all of that industry jargon. Today is all about the basic mechanics of life insurance, premiums, death benefits, beneficiaries, explained in plain English so you actually understand what you're buying.
To set the vibe for us today, check out this quote from licensed insurance professional Paul G. Wild. He operates on a philosophy that I just absolutely love. Insurance should be explained without pressure, unnecessary complexity, or exaggerated promises. And honestly, that hit the nail on the head. That is exactly what we are going to do today. We're relying purely on grounded facts from consumer buyer guides and tax guidelines to give you a reassuring, totally educational look at how this all actually works.
So, here's our agenda. We'll start off with plain English, please, then hit the 3 basic mechanics. After that, we'll weigh term versus cash value, tackle the tax question, and finally wrap it all up with assessing your needs.
Section 1. Plain English, please. Okay, before we even look at a single policy type, we've got to establish a major ground rule. You absolutely have to educate yourself before letting anyone recommend a product to you. Life insurance is definitely not a one-size-fits-all solution. You really need to understand 3 core things: how the product works, what it costs, and most importantly, what is actually guaranteed. You have to separate those ironclad guarantees from the rosy projections they might show you. We have to look at the cold, hard facts in plain English before making any calls.
Section 2. The 3 basic mechanics.
Let's dive right into this. If you can grasp these 3 foundational building blocks, you've pretty much unlocked the core of almost any policy out there. First up is your premium. Put simply, this is your cost. It's the money you pay while you're alive in exchange for the actual coverage. Now, when you're looking at premiums, long-term affordability is absolutely crucial. You have to ask yourself, sure, I can afford this today, but what if the premium jumps later on? Because some do, based on claims costs or investments. Will you still be able to afford it 10 years from now? It's a real long-term commitment.
The second mechanic is the death benefit. I mean, this is literally the whole reason you buy the policy in the first place, right? It's the payout, the money the insurance company pays if you pass away while the policy is active. What you're really buying here is a financial safety net for the people you leave behind. This money steps in to replace your lost income, cover funeral costs, knock out debts, or just keep up with childcare when you're gone.
And mechanic number 3 is the beneficiary. This is the specific person or even an organization that you name to actually receive that death benefit. Now, here's a massive tip from the NAIC, and you really need to hear this. Experts say you should never, ever name a minor child as your direct beneficiary. Surprising, right? But if you do, that money can get tangled up in crazy expensive, drawn-out court proceedings just to appoint a legal guardian for the funds. So you usually want to look into leaving it to your estate or a trust instead.
Section 3. Term versus cash value.
All right, so this right here is the main fork in the road for buyers. We're going to compare the major policy categories based purely on time and cost. Now, term insurance is exactly what it sounds like. It covers you for a specific period of time, a term. It's generally way cheaper upfront, but it doesn't build up any extra cash value. Cash value insurance, on the flip side, is built for your entire lifetime. And because it's meant to be permanent, it can actually be more cost-effective over a super long timeline. Plus, it builds up usable monetary cash value right inside the policy as the years roll on. Now, what's really interesting here is when you look at cash value policies, you're mostly choosing between whole life and universal life. The big difference? It all boils down to how you pay for them. With whole life, you pay your premiums on a strict set schedule. It is super predictable. Universal life, though, gives you a flexible payment pattern. You can actually adjust how much you pay just as long as you're putting in enough to keep the policy active.
Let's jump back to term insurance for just a sec, because you've got another big choice there: renewable versus non-renewable. If you go with a renewable term policy, you have the right to keep your coverage when that initial time period ends, even if your health is completely tanked. But, and it's a big but, renewing almost always means getting hit with much higher premiums. A non-renewable term policy, it just ends. If you want coverage again, you're starting from scratch with a brand new application and all those health screenings all over again.
Section 4. The tax question.
We are going straight to the IRS rules to tackle the single most anxiety-inducing question people have about that final payout. Do I report life insurance proceeds as taxable income? I mean, think about it. If your beneficiary gets a massive payout, is the government going to swoop in and take a huge cut of it for income taxes?
Well, you can breathe a sigh of relief. The general rule is no. Generally, life insurance proceeds that you receive as a beneficiary are not included in your gross income. You usually don't have to report them on your tax return at all. That means the death benefit goes exactly where it's supposed to, entirely to the person who needs it.
That said, the IRS does have a couple of specific exceptions you need to know about. First off, if the payout is delayed and actually earns interest before it gets to you, yeah, that interest part is taxable. You got to report that. Second, if the policy was transferred to you in exchange for cash or something else of value before the person died, then things get tricky and a portion of that money might be taxable. But honestly, for the vast majority of standard beneficiaries out there, that base payout is totally tax-free.
Section 5. Assessing your needs.
Okay, so now that you've got the mechanics, the policy types, and the tax rules down, how do you actually figure out what you need for your own family? The NIIC lays out a solid 4-step self-assessment. First, identify your dependents, who literally relies on your money. Second, calculate the chunk of family income that you personally provide. Third, estimate your final expenses and debts, like that mortgage. And fourth, look at what coverage you already have through work. But a quick warning on that last one. Employer insurance is great, but it's rarely enough. And if you leave that job, you usually can't take the coverage with you. Having your own standalone policy is an absolute game changer.
Once you nail down what you need, you've got to face the application process. And look, here's the reality. Truthfulness is absolutely mandatory. If the insurance company finds out you lied on the application later on, they can reduce your payout or just cancel your coverage entirely. Depending on the policy, you might have to answer deep dive health questions or even get a quick medical exam. And remember this golden rule. The policies that let you skip the doctor and the health questions, they almost always cost more and give you less coverage.
So the huge takeaway here is this. Once you finally get your policy, please don't just shove it in a drawer and forget about it. You need to review your coverage and your beneficiaries every few years. Life changes fast, right? Getting married, getting divorced, switching jobs, having a kid, all of that completely changes your life insurance needs. And you can usually update your beneficiaries for free, so make sure your policy actually matches your real life.
And that brings us to the end of our explainer. We've swapped out the industry jargon for plain English, covered the big mechanics like premiums and beneficiaries, and even dug into tax codes. So I want to leave you with this one thought. If the unexpected happened tomorrow, are your financial responsibilities and your family's future fully protected? Take what you've learned here, go ask the right questions, and make absolutely sure you and your loved ones have the peace of mind you deserve.